JEPQ, the long-term king. Is it still the leader for the income from Nasdaq? Well, we're going to break it all down today. Welcome back to the channel, guys. I'm Doug, the retirement guy, with all your monthly ETFs. JEPQ has been in a lot of retirement portfolios. It has been one of those funds that people turn to as security, as luxury. They want some income out of it, some nice growth out of it. It's a proven strategy. But we're going to look at it deeper today and say, hey, what makes it work? How does it do it? And is it still the strong player that's out there? Before we get into it, I got to say a shout out to everyone who's in our Patreon group. Man, thank you for supporting the channel. If you're able to help the channel, go down in the description. You'll see a link there. Help with the Patreon. You know, the worst thing is you can sign up for free. You can sign up for a small little donation, or you can do a monthly side of it as well. All it does is keep the site rolling, keeps us rolling, that we can keep putting out these videos for you. Other side, don't be afraid to hit that like button if you like the video that we're doing, and also don't be afraid to hit the subscribe. You'd love to join the over 13,000 people who have already watched our videos on a regular basis. So let's get into today's video. We do have to do the disclaimer, and that is past performances don't guarantee your future results, and this information in this video is for educational and informational purposes only. I am not a licensed financial advisor. I am just one who's been studying this stuff for years. The example and suggestions discussed here are basically not suitable for all individual situations, so always contact a financial advisor before making financial decisions. So JPMorgan Nasdaq Equity Premium Income ETF, better known as JEPQ. Now this fund is an actively managed fund, and it uses U.S. large cap companies from the Nasdaq 100. So they're following Nasdaq to a point, but they're only using the U.S. companies. It assesses and manages using an ESG factors, and they're using their own data science driven approach to find which funds will work the best to help do what they want to do. The fund also invests into ELNs and is seeking income generation. So this fund came out in May 3rd. So realistically, at the day of filming this, we're only a day away from its 4th birthday. So happy birthday, JPMorgan, and welcome aboard. So this one uses the Nasdaq exchange. Now, this thing has outstanding shares of over 635 million shares outstanding, and their fund's assets are over $37 billion across the board. They have 108 different holdings, and here's the great one. Their 12-month rolling dividend yield is about 11.11%, and they're currently, as of the end of March, they have an 11.98% SEC 30-day yield. So let's pop the hood on this one, take a little closer look to it over the past 1 year. As I said, $37 billion in assets, an expense ratio lower than most in the category at 0.35%. 630 million shares outstanding in the past 12 months, paid $6.18 in dividends for a yield of 10.51%. Now, this fund has bounced between $51.02 to $60.14, and the past days of trading are $58.74 to $58.92. So we're just about $2 below the 50-week 2 high, but we're definitely nowhere. We're $7 away from the 52-week low. So we're playing right in the high end, I'll call it, of the stratosphere of this particular fund. We look at the charts. We did have a major drop off in April, as we're going to see that pretty much in every fund that we show, because we entered into the Iran war. But look at the recovery. This is the thing that's getting me from this. The Iran war was not. It was I call it a bad news cycle. No one has had any issues. The funds that we're going to show are not having issues. It was just bad news cycle, because the recovery came back so strong and even stronger than it did before. So the growth so far 1 year out is 14.55% with that yield of 10.51, giving us a total return right around 28.06%. So this is why you can see this fund is actually added in a lot of retirement accounts, because it's giving you a mixture of about a 50-50 blend of yield versus growth. So a very smooth runner across the board. When we take a look at the year to date, which would give you January 1 to basically April 30th of this year, you can see the growth has actually been down because of that April kick into, but it's recovered back to get us back to a positive 1.19. The yield's a little bit higher at 3.58. Now remember, this is 4 months of yield. So if you take and times that by 3, you're going to see we're going to be right back into about that 10 to 11% category. So it's right on track, still producing the proper yield that we like. This is why retirement funds and different builders love this part, because it's a very consistent piece. Total return year to date so far, 4.07%. Now remember, all these numbers can change in a matter of a second. If the stock market opens up and these start trading, these numbers can all change dramatically. Popping the hood a little different, you can see this one has 43% into technology, 11% into consumer discretionary, and 8.73% in communications, adding into healthcare, consumer staples, and industrial making up. So similar to what the Nasdaq is, Nasdaq's a little heavier into tech, a little heavier into consumer discretion, but a lot of these are built for income that Nasdaq is not built for. Looking at their core, when you look at the companies that are inside of what they're doing, NVIDIA, Apple, Google, Microsoft, Amazon, Meta, you just go on the list all the way down. Fairly well balanced. NVIDIA's, we're finding a lot of weight at the top end with NVIDIA because they're doing so darn good. So now we take a look at the dividend chart, and you can see that it has some little spikes here and there, how things have flown. You can see the little dip off in the end of 2025. You see the dip off in the April 26, but overall the steadiness of the fund has been fairly smooth. The dividend average is about 52 cents a share per month. Okay, you look at the chart, 55 cents, a little bit above it in April, just a hair below it in March. February is a little off, but you can see, you can count it. The numbers are not that far off. We're talking just pennies across the board. So very strong income across the board. Now, how are the taxes handled? This is the one black eye that JPMorgan technically has in this particular fund, because most of the distributions are set to you as ordinary income. So if you're putting this in a brokerage fund, you're basically going to pay the most in taxes with this type of fund. This is one that you really want to have in a 401k or a Roth IRA, and that's why it's used heavily into retirement packages, and they weren't worried about this at that point. Now, I will tell you too that we covered this in a couple different videos, that they came out with whole new funds to help fix this problem and giving you that package for the brokerage side. But let's just continue with this. Most distributions are ordinary, unlike dividend ETFs like SCHD, that pay qualified dividends that are taxed at lower rates of anywhere from 0, 15, or 20%. A large portion of JPQ's monthly payouts are ordinary income, so you're going to pay ordinary taxes. So JPQ generates most of its cash by selling call options via their equity-linked notes, those ELNs we talked about. The impact is that the income is taxed at your standard federal income tax bracket, which can be as high as 37%. Now, the role of those ELNs, those equity notes, they don't just sell covered calls. It's a traditional sense of holding the stock and selling a contract against it. Instead, it uses the ELNs with derivative instruments that package the call writing strategy into a single security. The benefit is the ELNs help the fund provide a steady monthly payout, which, we showed that. We've seen that exactly working. But the tax trap that comes in is many years the income for these notes are treated as ordinary income or short-term gains rather than that favorable long-term capital gains that you hear a lot of talking about, that 60-40 program. So it is, like I said, the downfall of the fund if you need to have one. So let's take a look at the total return numbers again. Total return year to date, 4.02. Over the past 12 months, 28.06%. Prior to the April cutoff, it was bouncing in that positive, I'm just going to put it as a +1, a -1 category. So it was just bouncing kind of like, and we see this, and I can tell you the reason for it is because most of these funds were looking at saying, what direction are we going? Where's the market going? Where are you heading? You're giving us mixed information, and they're just bouncing. And then we went to war, and everyone, again, the negative news breaks out. And once they realized what we're doing, how successful we were so quickly into that war, it bounced right back and said, okay, we know what direction you're heading to. We know what you're doing. And they're able to move forward. That's why we've seen the big gains. Across the board, you see the same thing in the total year to date. It's been hesitant, holding back, but always staying in that positive range. So, good for retirement? Well, this one you really have to say yes. It is strong for in a retirement fund, other than the tax burden. That's the only thing I have to tell you about. So, why I say for retirement, it's great because you actually have an income and a growth in piece of the puzzle. So you could actually put this in the classifications that I tell everybody is my 3-bucket system is foundation, 2 is growth, and 3 is income. Okay. And so income is what you're living off of. So this one here, a 10%, 10.51% yield. We've shown you earlier that it's pretty steady. It's been very consistent, that I can say. But of course, everything always changes. And the growth at 14.55% is a strong piece on top of all that. So you could actually do this in multiple ways, depending on what your portfolio needs and what you need in retirement, which is you could create this as a growth fund, take the yield and use it as drip it into the growth to continue to grow the fund bigger and bigger. Or you can basically put it in the income side and have growth going to it and pulling 10% off across the board. The numbers all look good year to date, the past 12 months, and the year to date, and the year to date of the total returns all look good. So for me, across the board, this fund, hands down, is definitely a fund to have in a retirement account, and you just have to work your taxes in a slightly different manner. Let me know what your thoughts is. Do you think that this should be in a retirement fund? Maybe you own it. Maybe you're a part of it. Let me know in the comments below. I'd love to hear from you, your thoughts, and if you like what we're doing. Don't be afraid to hit that like button.
Thank you for watching. Press the